So I absolutely love it when viewers of the channel bring new companies to my attention, and some of those can be hidden gems. And so thanks a lot for pointing them out. And I love creating these videos, and I love analyzing companies. So if you have any other ones that you'd like me to examine that you think are interesting, let me know, and I can potentially add them to my short list and make videos for those. Hopefully people enjoy those as well. So today we're gonna be looking at a suggested company from a viewer of the channel, and it's called Maxar Technologies. I wasn't aware of the company. It's a satellite, sort of like aerospace and defense industry company. And in this video, we generally examine companies based on what they are doing financially. When you want to examine a company based on other metrics as well, like what kind of strategies they have, and what kind of people do they have behind their executives, really, you can definitely do that, and you can read the 10K, for example, and discover a lot of information about who their customers are and all that jazz. But that would take ages, of course, and requires much, much deeper analysis. However, financial analysis can give us a very, very nice baseline. And in this video, we're going to be examining the finances of the company and also make a discounted cash flow model that we're going to use to project how much we would be willing to pay for Maxar today. And stay tuned, because this is going to be interesting. I can tell you that from now, having pre-calculated everything. So, what we're seeing here from the company, the outstanding shares are 72 million. It's a low outstanding shares company, but look at this. This has been increasing massively over here. And the company has been issuing shares, trying to take advantage, obviously, of the higher prices here. And so if you bought at these levels, actually, where they are issuing, I think they were issuing shares back in 2014, right? Yeah, so 2017. So you would expect that. Look at where the price of the stock was back then. And so this is why you would want to be examining how much you are paying in terms of how much the company is making. You don't want to go overboard doing that, because if you do that, then you end up buying expensively and the company starts diluting you, and then you are actually losing money because of that. Now that's a different story now, because the company is worth way less. But the problem is that we are seeing that the company dilutes investors, and so that's something that is, generally speaking, bad to see. I don't like seeing that at all. Now, next thing, we are taking a look at the income statement of the company. See what's going on there with their revenues and everything. Yeah, this company was a little bit all over the place. You would notice some years where it was like minus 20%, then it was plus 40%. So it's a little bit all over the place, and you can't really use those to project growth into the future very well. You see that, for instance, in 2018 they had massive growth, and then it was a minus. So yeah, this is weird, really. And you will see that the net income again is 60. Then they lost a lot in 2018, but then it's steadily up with the exception of the last 12 months, I guess, where they lost money. So as you can see, it's a little bit all over the place. This is where it potentially pays to read the 10K and see what kind of customers they have, what kind of clients, actually, in this case, and analyze a little bit more. But the total assets of the company are actually going down here. As you see, 2017 they had more. And I'm assuming this happened because they actually sold a lot of stock, and they got assets that they eventually had to spend for liabilities for potentially. And total liabilities of the company are 3 billion. So it's coming close, it's creeping closer to the assets. And the cash flow of the company, cash from operations, is positive, and that's always a good thing, and slightly increasing from the previous year if you exclude 2019, of course. I guess it may be a company that gets affected from COVID. I'm not sure. Cash from financing, companies investing a little bit. They did actually get some other investing activities. They probably sold some investments here, but overall they seem to be investing, and their capital expenditures are not going up, which is good to see. So the cash from financing here, what happened here? So we are seeing that they issued debt as well as selling stock, I guess. So issuance of common stock also happened in the last 12 months. And overall, it's for the most part negative now, which is a good thing. The free cash flow, again, it's a little bit all over the place. 62 then losing 11, then 60, then losing 32, then 89. I mean, you cannot really use that to make careful projections here, can you? The multiples of the company, this is good. This is very good, actually. These are very low. And it means that the value of the company, basically the market cap, enterprise value is what EV is slightly different than the market cap, but it's close for the most part. And oh, this one has a big difference because of debt. Okay, so yeah, this one has a lot of debt here. Interesting to see. So regardless, let me go take it back. The actual ratios here of the multiples of the EV to sales are actually low, which is good to see, and the price to sales too. You want low values here, as low as possible. And profitability, yeah, the company is not really profitable. I mean, we saw it in the free cash flow really. And the solvency ratings here, yeah, you would expect that. We just saw that the company has a lot of debt, and so the debt to equity is very high here. That's not a good sign. It used to be higher though, which is a good sign. It looks like it's going down. So a little bit of a concern here. The company has a lot of debt, and this is starting to become quite a lot of debt really. So I don't like to see that. I hope they can actually remove that debt soon, pay it back pretty soon. So this is a concern that I have. I don't like companies that have that much debt when you compare it to equity. And the thing is, we saw in their balance sheet that they had, what was it? Let me find it here. 3 billion total liabilities, and they are not making any cash flow. So they would have to either get some loans or sell more stock to investors and dilute them more. So that's not great to see. Regardless, let's take a look now at the cash flow statement that I have created, the DCF model that I have created here, which we can use the free cash flow that the company is making to project how much to pay for it today if we want to purchase it. And you will see that the free cash flow growth is all over the place, and you cannot really estimate it very well. Many years were actually negative here, some years. And so this is not easy to estimate. And actually, I think I made a mistake here. Yeah, this was actually minus 32 over here. Let me fix that. All right. So it doesn't really matter that much because the projections happen from this year, which it starts at the 90 million, basically last 12 months. So what do we want to be using here? We're going to be using a discount rate of, I want to be using something like 14% here because it's a much riskier stock to own than other stocks. So I want to be getting a little bit more money if I'm to invest in this one. The free cash flow growth to use here now is very, very tricky because you will see the free cash flow growth is all over the place now. From year 1 to year 2, it went negative, then it went positive again, and then it went negative again, and then it went positive again. So what can you really use here? I can basically, take a look at the potential, like take a look at the total revenue year over year growth, and kinda also use that to help me a little bit. But I think it would make sense to be conservative here and use something like 10%. And it may even be too much actually. It really depends on what the company is going to do in the next few years really, and we don't really have a baseline to be certain about it. So the perpetual growth rate that we're going to be using for the terminal value of the company is going to be 1%, the typical. And the outstanding shares are here. I have actually pre-added this value here, have pre-populated it. And so it's about 73 million. Remember, they keep diluting, so this could go up very, very soon, and that's not good. So the price per share to pay today, if we're looking at these projections, which, yeah, they are conservative. I mean, the company could do better. But this is what we have here in terms of free cash flow. Again, it's a little bit all over the place. If we knew that the free cash flow of the company is going up a lot, and it's not really a lot, to tell you the truth, like 10% is not a lot in this case. So they could achieve 10%, but we're talking about the next 10 years. But 10%, I mean, if they are doing well, they could achieve 30% or even 40%, at least for many of those years. I just want to start with being a little bit conservative. So the first estimate that we can use here is $16.78 that we want to be buying the company, which is far from what it currently is at $27, almost $28. But if we project that the free cash flow is going to be 20%, which could happen, Now we're getting a value of $32 per share. And in this situation, we're actually within our limits of buying the stock, and actually less than, it's actually significantly less than that. So what about 15%? 15% is sitting at 23.24, which is slightly less than what we would want to achieve. So maybe a value of 17 would do it here. Yeah, about 17, I guess. 17 to 18 is probably right. So if we use 18, then yeah, we're within our limit. So if we actually expect the company to grow year over year at the rate of 18%, which could happen, although again, remember, this is for 10 years time, you can see that here, then we're looking at a company that's, that can give us this outstanding, this price per share, and this cash flow per year for our sake, this discount rate of 14%. And some years they could actually be more, some years they could be less, but we want to be achieving a similar scenario in order to apply for this one and actually purchase the stock at this price. So if we are talking about a discount rate of 15%, then we are again at a very similar level, and would probably want a little bit more growth to achieve the current price that we want to buy it being the same as today or similar. So what am I thinking about this one? This is a very, very interesting stock and a very interesting company. It's a growth play, for which we don't have a lot of data. This is a company that you can risk some money and make a lot out of it. And the nice thing is that it has dropped quite significantly. The only thing that really concerns me here is the debt of the company. The company seems to be having a lot of debt, and it's something that I don't like. They're actually paying a little bit of dividend as well. There's almost nothing though, and I'm assuming that they're gonna stop it at some point, although it's probably very, very little of their cash flow, but they're not making cash flow, so that's a little bit weird that they're paying that. Actually, they stopped paying it, it looks like. Oh no, they decreased it, so they were paying more. Yeah, that makes sense because they don't have free cash flow, as you can see, so they basically brought it to zero, and this is probably what made the stock decline a lot. And that makes sense because they did decrease it in 2018, it looks like. And so if we take a look at the overview here, you will see, yeah, this is where it started to go down and down and down. Then it went up again, but then now it's also stabilizing a little bit and going downwards. So yeah, this is how the company looks. I mean, it's not a terrible play for sure. I could definitely see someone buying this and making money in the future. But again, you'd have to think that this company has to grow a lot in order to make a significant amount of money. And you could actually make a very good amount of money here if the company keeps on growing. So if you are not too scared about the debt, which is concerning, and for me I am scared about this is why I use a discount rate of 15% because I have more risk here, as I mentioned earlier, or 14%. But if you are not that much concerned about this, and it's a good thing that they actually brought their debt to equity ratio down, it's a good thing, so they're actually repaying some debt. You could enter this, but it's 3 points really. Not being concerned too much about this, the dilution of stock, which is important because they do dilute stockholders a lot. Hopefully they will stop it at some point. The debt levels are a little bit higher than I would want. And then you'd have to account for potential growth here. You need to expect good growth for the company, which is achievable because it's not out of the ordinary. Many companies have this kind of growth for many years. And this is actually a small company also. It's a $2 billion company. So it's a very small company. It could easily achieve this kind of growth. So for me, this is interesting. I wouldn't say it's a buy for sure, but it's definitely interesting. I could see myself adding a little bit of this. I'd probably need to research a little bit more about as I mentioned earlier, about their clients, what kind of clients they have, and some information about their future, really. Maybe future contracts and things of that sort. So it's an interesting one. Let me know what you think with a comment below. Hopefully you enjoyed this video about a much smaller company, but an interesting one. So if you did like the video, please leave a like, because that helps a lot, and subscribe to the channel. Love to see you here. And if you enjoy this kind of content, take a look at this video that I made earlier. It's about Adobe. Thanks a lot, and I'll see you soon. Bye-bye.